This screencast is going to look at summer 2015 question 2, so the group question, and this particular year it was a group statement of cash flows. So one of the important things before you go on and look at this question now, before you attempt to make sure you're comfortable, particularly look at chapter 11 in the Mahoney textbook. It's a very good introductory in terms of what statement of cash flows is about, particularly in a group context. And also remember there's some prerequisites that you need to know here before you need to go on to this study or this section. So you need to know how to prepare an individual set of company statement of cash flows, because ultimately it's a bit of a change here now in terms of how we approach a group question. It's no longer similar to what we do comparing the statement of financial position and a statement of profit and loss and other comprehensive income. You're now approaching it as if you're preparing a statement of cash flows. So slightly change in focus, and as well as that you also need to be very well up to speed on how to deal with norm and consolidation questions, because it builds on those principles. So we have a different approach now. We're going to approach it as if we're going to approach a normal IAS 7 individual company statement of cash flows. But again, some adjustments are going to be there for group specific issues such as acquisition and disposal during the year, the NCI and associate or any joint venture. Right. And one thing, this goes for normal cash flows and consolidated cash flows, make sure to use a T account, particularly on complex line items where there's a lot of moving parts. It's useful to use a T account so you don't get confused. So if we go to the question then, what I like to do for students, particularly either you're doing a question 1 or you're doing a group account question, is to have some approach. So if we just look here, I've set out, now you can pause this and take a look at it and take down any of the steps, but I give you a suggested approach on how you approach a consolidated SOCF. So some of the points are very similar to question 1, but some will change then. So step 1 is really just understand what's asked, if it's just an SOCF, and understand the information given. Excuse me. So in particular in terms of what is the table of information and any unusual line items. Step 2 then, read down through the notes and just get a bearing on key dates, links between the notes, and in particular key cash flow adjustments. So any ones that typically come up like revaluations, disposals, etc. Then, and this is important here, is you're going to know the answer to this SOCF before you begin. So calculate it just so you have an idea of where you're aiming for. Work out the answer. What is the movement in cash and cash equivalents during the period? So you'll know to be able to figure that out. And then just set up a placeholder, consolidated statement of cash flows. So just set out, leave a page, leave 2 pages, and then that will, so you won't never have to go back and try and fit in extra line items. You know you've left that space, and then go down and start your appendix. Step 4, start with the operating cash flows. So again, you start off with your operating profit line and you get your non-cash items, very similar to an individual IAS 7 question. My advice would be here, create a list of typical ones. So you're always going to have depreciation, amortization, you might have profit or loss on disposal. So the typical non-cash item adjustments that you typically see in questions. And one point here is, if you're not told about depreciation or you're not told about impairment or amortization, you may need to go back and redo either the PPE T account if you're not told depreciation, or you may need to do the goodwill calculation on your acquisition or disposal of a sub to figure out if there's any impairment to slot into the non-cash adjustments. So you may have to go a step ahead to figure out what are the slot non-cash adjustments such as depreciation and amortization if you're not told. However, we're told directly in this question, but just be on alert. If you're not told, you may have to figure it out yourself. Then deal with any acquisition or disposal during the period. So you may have an acquisition or a disposal, typically in a consolidated one, you will during the period. So that will involve figuring out first, what was the goodwill, figuring out any NCI, and also figuring out the net cash cost or proceeds. So how much did you sell the sub for, or how much did you buy the sub for? Then it's very much take a line by line item, so take each line item in the consolidated SOFP and explain that movement. So you're seeing it as a puzzle. You're trying to explain how did the PPE go from X last year to Y this year, using your notes and using the consolidated statement of profit and loss and other comprehensive income to help you fill in those gaps. So my advice again is to use a T account, but also do a cheat sheet up, particularly for the difficult areas such as property, plant and equipment, NCI and retained earnings. So it just gives you an idea of what's the things to watch out for and the key mistakes that you regularly make when you attempt these questions. Finally then, as you do each line item, populate into the relevant section, so whether it goes in investing activities or financing activities. And finally then, tot up your SOCF and compare to step 3, because remember we know what the answer is. And if it's not coming out, then go down through each line item in the statement of financial position and just make sure you've explained that movement, each of them. Because sometimes students forget to explain the retained earnings movement or forget the ordinary share capital line. Just watch out for them as you go down the line. Okay? So again, my advice here, they're only high-level steps. With practice, you're going to refine your own approach. And there's some key tips that I say. Focus on the basics first. You need to know your individual statement of cash flows, and you need to know group accounting. There's no point coming here unless you know them. And you need to know how to deal with key areas. So acquisition or disposal of sub during the year, property, plant and equipment, non-controlling interest. Use T accounts. It's a lot easier. We'll see I'll use T accounts throughout here, but it's very easy to track them, what's going on, and you'll know, right, what is the missing entry here. And finally then, it's my kind of advice to always the students when you're starting off any statement of cash flow is see it as a puzzle. You know what the end answer is, and all you're trying to do is explain that end answer by explaining the movement in each line item in the statement of financial position. So how did each line item move from the year, using this blocky and any notes to the question to help you explain that. Right, so if you understand that perspective, it makes it a lot more approachable. So again, you can pause that, take it down, but as I said yourself, you may want to adjust to your own approach as you try more questions. But the key thing is, you need an approach. There's no point trying to do this ad hoc on the day of the exam. You'll end up wasting a lot of time. So if we put that back a second, we look at the question. So first one, let's look at the requirements. So in terms of here, we're asked to prepare the consolidated cash flows for Vantech in accordance with IAS 7. So nothing more, 25 marks. Based on a 3.5-hour exam, you're probably talking in and around ballpark 50 minutes. Right? So it is a tough task, but again, manageable if you have a good approach to the question. So we just have a quick read down through it. Nothing really here in terms of just giving you the consolidated SOFP and the consolidated SPLOCI. So my advice when you're reading down through the numbers, first just highlight any unusual area that you might have to come back to. So you see all these movements, and we're trying to explain these movements in terms of, well, how can we prepare a cash flow to explain how all of these have moved, where's the cash element of that movement. So nothing unusual there. That's our answer. So bank and cash, just check we've no overdraft. So we know bank and cash for the year has gone from 380 to 140. It's gone up by 240. Hence that's your step 3, work out the answer. It's just useful to have that in the back of your mind. Ordinary share capital, that has moved, so is share premium. So I'll know, and you get more refined as you go through questions. We have a share issue or something during the period to move share capital, so we'll watch for that. Watch for evaluation surplus, it's decreased, so we better make sure, and there's a relevant note to that. And you've obviously your NCI. So we're just taking a note of the key elements, and in case the examiner's been nice here that they've put notes or cross-reference the notes for you. And again, you're told information about this blocky, and there's a note, and how the profit is attributable to the owners of the parent and the NCI. So again, that's just very brief. Again, we're labouring it here, but it's very much 30 seconds will do that. You might just highlight some key areas that you have to go back to, like the revaluation reserve. So now we just do a quick look at the notes. We're told here depreciation of PPE and amortization of tangible assets are X and Y, and they've already been charged here. So you know straight away, well, one, these are going to have to be non-cash adjustments, and secondly, when we're doing our explanation of PPE and we're doing our explanation of the movement here, we know one of those items that go into our T account are these two figures. So there's a double use of them, don't forget that. So similar here, in terms of there's a profit on disposal of some PPE. So you made a profit of 30, so again that is a non-cash item. So it'll be in your SPLOCI, but it's not a cash item. You figure out what the cash item is, and there's disposal. So you know straight away there's a couple of elements here, and again that's why I said do up a list of typical ones and remember what happens. Because here, well, one, you have to make a non-cash adjustment, that's the profit on disposal. You have to figure out, well, how much cash did I get in on the disposal? And thirdly, you have to adjust the property, plant and equipment T account for any disposal figure to explain that some of that movement here was due to a disposal during the period. Right, so there's a bit involved there, and that's why I said T accounts can be very useful. You note 3 up here was to do with the revaluation surplus, and that is all attached to property. So again, we have to go back now and say, well, again, link that to the property, plant and equipment and put that into the T account as well. So on the 1st of June, again noting key dates, we bought a sub. Right? So you purchased all the share capital. So no extra non-controlling interest here. You purchased all the share capital. You bought these net assets, so assets and liabilities, and that's how much you paid for it. So you'll notice straight away, and it's a good thing to understand, well, some of these will explain the movements in these line items, and we need to take account of that in T accounts. And here's some. We issued new shares, which again the good student will link to. Well, that must explain some of the increase here in the share issue. And we also paid some cash, so we'll have to account for that as well. And you'll notice, well, actually we paid as much as we got, so there's actually no goodwill here. So it's just a good sense check at the start. Key date, mid-year acquisition, we're going to have to account for that during the statement of cash flow prep. Second last thing we're told about interest due, so under trade and other payables, so we know up here, actually they are not all trade payables, so we need to strip that out and say, well, what is trade payables to do our working capital adjustments? And the next thing then is, well, what are other payables and where are they relevant? So we have to deal with this when we deal with interest, and when we deal with property, plant and equipment, we need to deal with this other payable as well. So it's just to split out. And finally you're told there were no movements in retained earnings other than profits and dividends for the year. So whatever this movement is up here, to explain it, it's either going to be due to the splockie and the profits we made here, or dividends, which is typically the plug figure that you have to calculate. Right? So there's a bit involved there, but again, the more practice you get at these questions, the more refined you are in terms of realizing, or what are the key things I'm looking for here, and how you're going to note those key issues as you go down along. So first step we're going to take is start with the operating cash flows. So my advice to all students, start with the operating profit. So this is profit before tax, but typically operating profit, they don't show the line item here. You add back finance costs as well, because you're going to do finance costs paid down further on. So we go back here and we'll start with operating profit, and you can say that comes to the question. So you just note reference question, because when we start doing actual workings, we want to put in a bit more detail there. So what you're going to do is operating profit here, and it's going to be the 5435, add back your interest. So 5670 is your operating profit for the 2014 year. So that's your starting point. And now we'll call first thing again non-cash adjustments. So note this approach is the exact same as how you do a normal IAS 7 question. We just have a few complexities as we go through in terms of group accounting, so NCI, etc. So start off with the easy ones that we know we've already in the question. We know there's depreciation and amortization, we're told it. Again, remember, as I said before, if you're not told these, you typically may have to go back and do your property, plant and equipment, or do your intangible asset or goodwill account to figure out what the plug figure is, which essentially will be amortization or depreciation. So sometimes they will give it to you in the question, sometimes you may have to work it out. So depreciation, amortization. So we'll just figure here, again, we'll just call this note 1. So note 1 of the question, just to show the examiner where you're getting it from. This was 3220 and this was 95. So nothing more complicated than that, and notice your building marks as you go along. The only other non-cash item that we really came across here was the profit on disposal. So remember, the profit on disposal is not really a cash figure. You've got some cash in, but the profit on disposal is really just an accounting entry. And a lot of students make the mistake here. If it's a profit on disposal, well, it's already increasing your profit, so you know how to strip it out, because you're saying that's nothing to do with cash flow. It's really just an accounting entry. So you go minus 30 to strip out the profit on disposal. Now what you can do here is you might leave a few line items and just go on to the next section if you're not sure if there's any other non-cash items. But we know already there's nothing else in the question mentioned that's not non-cash. So we might add these together. The sum, and the adjustment is then 3285, and so we add those just after non-cash adjustments, and we've 8955 to bring down. So that's your first step, is always to get your non-cash adjustments. Right? And seeing sometimes you may have to have added complexity that you go a step ahead to figure out what these are and work back into them. The next question then typically is, once you have your non-cash adjustments, you should do your working capital adjustments. Right? So because working capital is moved during the period, that will have an impact on cash flow, so we need to now look at that working capital adjustments. So working capital adjustments, again very similar to the individual one, so if you're not comfortable with these you need to go back and revise working capital adjustments under IAS 7 the individual. So we look at we'll look at inventory, we'll look at trade receivables and trade payables. So you're probably going to have to do a note for this because there is one complexity, so we call this working one, so again it's useful to keep these separate at the end. Remember, because it is group statement of cash flows, we have an acquisition during the period that, well actually we need to strip out any impact of that acquisition, or should it be a disposal. So that is the one complexity when you're dealing with working capital adjustments in comparison to an individual cash flow. You need to strip out any impact of a mid-year acquisition or disposal. We'll do inventory, we'll do trade receivables, and we'll do trade payables. So you typically just start with the closing balance, compare that to the opening, and you'll get the movement. So fairly straightforward so far, nothing changed compared to IAS 7, the normal question. So closing inventory was 1040, opening inventory is 980, therefore movement was an increase of 60. So again, all kind of straightforward there so far. So we'll just put a line on these. Trade receivables the same, 5910 was the opening, or the closing should I say, 5350 was the opening, and again it's an increase of 560. And the final one then is trade payables. The closing was, now this is important, remember we noted this already in note 5, we need to strip out any impact of other payables here because these are dealt with somewhere else. So 14120 and a 35. So the closing balance here was plus 2160 minus 120 minus 40. So to strip out, then we're only looking at trade payables, and then plus here 1960 minus 35. And the difference here then, there was an increase of 75. So that's typically what you'd always do, and then you'd figure out, well, does an increase mean a positive or a negative impact on cash flow? But now you have an AC of sub, so you need to strip out the AC as a sub. So what you're technically saying is, well, we now acquired a sub during the period, for example inventory, which had 440 additional inventory that year. So that 440 is already in here, or part of it, in that impact. So actually, the real movement, the net movement, stripping out that sub, because we want to get the core movement to the business, is not an increase of 60, it's actually a decrease of 380. Because when you add these together, it gets you to your net 60. So you want to get the core business here. You're not worried about the sub, you want to strip out the impact of the sub. So that's one unusual thing, or different thing about group statement of cash flows. You need to adjust all these line items for the impact of any mid-year acquisition, or should it be a disposal either. Similarly here, we got 1020 in trade receivables, therefore actually the net movement was a decrease, minus, of 460. And the final one then, this was 790, so the net movement here was a decrease of 715. And then it's just useful to, what's the cash impact? Because remember, these are not all positive or negative. You have to make sure you get the right cash impact. So a decrease in inventory, that means you have less money tied up in inventory, so it's a positive. So I just put in something like that to think about. So students need to make sure they're comfortable with what that means. You've now less money tied up in trade receivables. Your trade receivable balance has gone down. It's stripping out the impact of the sub, therefore that's a positive as well. And of course trade payables is the opposite. Reduction in trade payables means, well, you're getting less trade credit from your creditors or suppliers. That's a negative. So positive 380, positive 460, and negative 715. So again, the core up to here was the same as CAP1, or normal individual cash flow statements, and it's here where is the additional complexity for a group. So we'll just reference here, just to be nice and neat, similar to our question run approaches before. Working one, and that's plus 380 plus 460 minus 715. And again, similar to before, we'll just do up these. So that's the added in, and we'll add these together, giving you now down to 9080. So the only final step in this piece to get operating cash flows is working capital adjustments. The final one is interest and tax paid. Because remember, we started at the operating profit line, so we added back interest, we didn't take account of tax. So now we're looking for here interest paid and tax paid. And again, I tell students always take a T account approach to this. You may not need it for everything, but it's useful at the start to do a T account out. So we look at working 2 for tax. We'll look at interest first. So just merge, I'll just for these to merge and center. And we look at interest T account. Right, so we'll put this down here. Just so we have it fairly nice and neat. And we can copy that down. So we're looking at interest here. The first thing we're looking at, well, what is the opening balance and the interest owed? So are we told anything about the opening balance? We're not really told here. What other payables? But we are told down here, interest due, the opening balance, so put it here. We call it OB, was 35. So that's okay. We owe that at the start. In the splotchy for the year, we also had a finance cost, which obviously increases. The finance cost for the year was 235. So don't take this one. This was last year's, nothing to do with it. This year's figure is the one we're looking at, 235. So we owed 35 at the start. We owed an extra 235 during the year. That's 270. However, the closing balance, which again is balance carried down, we're told also in the question is 40. So that means if we add them together, well, we owe 270 and we only owe 40 at the end. The balancing figure here must be banked, and that's where the T account is useful. The balancing figure must be your 230. So now we have a balanced account, and we say we've spent 230 on interest in cash during the period, and we're only interested in the cash impact. So we go up here then, working 2, neatly cross-reference, and just put in minus 230. So again, it's nice, it's neat, and it's easy to follow for the examiner when they're looking through. Exact same approach in working 3 now for tax. So let's take this, copy it down, call this working 3, and we call this tax. So we take out these and we'll see what balances. So the opening balance in tax, so remember we always have interest and tax at the end, that's why it's useful to have a checklist at the start. You know the different line items you have to get through. So tax payable here, we owed 370 at the start, and at the end of the year we owed 410. That's okay. However, how much do we incur as a bill during the period? You look at your splotchy. So remember, we're solving a puzzle. How do we move from 370 to 410? We solve that using anything in the splotchy, which we're told is 590, and then the gap must be the difference, which is your 960 minus 410. So we've now explained the difference, saying, well, we moved from 370 to 410 by, well, 1, we had a bill of 590 during the period, but we only paid off 550. So an additional 40 we owe at the end, which is how you move that 40. That's why I tell students to look at it as a puzzle, because you're essentially trying to solve an answer you already know. So we look at here, that is minus 550. So adding them up gets our 8300. So we just put that top and we bold it, and we'll say cash from operating activities. So that's your first section done, your cash from operating activities. So if you go over to the steps, that's the first step 4. Now deal with the acquisition. So the acquisition typically has 2. Now if you haven't dealt with it already, you'll probably deal with it now. So remember I told you before, you may have to deal with it to figure out what the amortization or impairment of goodwill is. So here the acquisition was, well, firstly we figure out, was there any goodwill? So we look down here and we know already fair value of net assets acquired. Well, the fair value of net assets acquired was 4770, which is okay. The consideration paid, we also know in the form of shares and cash, was 4770. Therefore, goodwill is nil. So there's no goodwill here because there's no difference. You didn't pay over and above. And note that's important, because when you come up here to look at your intangible assets, you'll have no additional goodwill in here. So all this increase, when you account for amortization, must be acquisition of new intangible assets. None of it can be attributable to goodwill on the acquisition of this new sub. So that's one of the parts of dealing with the acquisition of a sub. The other part, if it's an acquisition or disposal, is cash paid. So net cash paid. And in B say net. So in this case you have to say how much cash paid for sub, and then also cash assumed from sub. So sometimes, not in this question now, but sometimes in questions you will also take on cash in the balance sheet. So the net impact has it reducing the overall cash paid. But in this case here, you paid minus 3750. You took on no extra cash, so there was no cash in the balance sheet at the date of acquisition. Therefore, the cost of acquiring the sub, which again from your perspective is an investing activity, is 3750. So you just put that in now. That's your acquisition done. Similar for disposal, you take net cash acquired or got from proceeds less any cash you gave away in the statement of financial position. So let's go up here. So we'll say cash from investing activities, and one is acquisition of sub, and we saw that working for, and we put it here minus 375. That's your first one done, is your acquisition of the sub for the period. So now we go on and we look at the steps. That's dealt with the acquisition if not already done so. Now we're going to just take each line item and work it out. So again, just start at the start, be very methodical. Start here. If we haven't explained, we've done inventory and trade receivables, we start at each single line item. Remember, we already worked out at the start the answer is 240. So you can put it up there if you want. We know the answer is 240. That's what we're trying to explain. So let's go back now and let's look at PPE. Right, so working 5. This is a difficult one. There's a lot involved here. That's why I think it's useful to use a T account setup. So we'll just use a T account here. I'm going to add in 2 more. So the opening balance is the other side for here. Just take it here. So PPE, you start with your opening balance, and we'll also come down here to a closing balance, because we know that as well. So we're trying to explain how did property, plant and equipment go from an opening balance of 23240 to a closing balance of 26540. So that's what we're trying to explain, and we're going to use the information in the question either in the statement of financial position or in the notes to help explain that. And the first bit of information we have is, well, just working out, we know the revaluation surplus is attached to property, plant and equipment. We're told that in note 3. So we know there's been a revaluation during the year downwards of 400,000. So if there was a revaluation downwards, it would be on the credit side, reval of 400. So that's essentially how you sub it in to make sure you're capturing all that impact. So we've explained one thing by one of the notes to the information. Another important thing that we're told here is, well, actually, we also had depreciation during the year of 3.22 million. So again, we know depreciation will reduce the value of the PPE, and you put that here, 3220. So again, we're gradually explaining what's going on from either side. So that's 2 elements. What other information are we given in the question about PPE? And one thing here is, we're told a profit has been recognised for the disposal of some equipment, which had a carrying amount at date of disposal of 470. So 3 elements here. One is the non-cash adjustment, which we've accounted for up here. Is your 30. Strip that out. The second thing I told you was, well, let's remove the carrying value from the property, plant and equipment account, because that is one of the explanations of the difference. So disposal of 470. And the final thing, just to capture it here as well, it's good practice, is, well, disposal proceeds. Yes, so there's always 3 elements to a disposal of property. 1 is the cash adjustment, 2 is the PPE account, and 3 is how much did you get in. Well, you sold it at a profit of 30 on a carrying value of 470, therefore you must have sold it for 470 plus the profit is 500. And that proceeds as well of 500,000 can, as a working 5, go in here. Investing disposal of PPE, working 5 of 500. Now note that will not go into the T account because you don't put the cash proceeds in the T account, you only remove the carrying amount, like a normal CAP2 financial accounting question. So that's an important one, and you can do a cheat sheet or a memory aid as to how to deal with a profit or loss on disposal. So moving down to note 4, do we have anything here in relative to PPE? And we do. So again, this is one of the changes in terms of having a group statement of or cash flow statement, is that you have to strip out or bring in any impact of the acquisition during the year. So we already did inventory, trade receivables and trade payables. We better make sure we account for the property, plant and equipment, the loans and the shares, and we've done the cash already. So that's just an added complexity that you should put in your cheat sheet as a remembrance or a memory aid when you're doing these questions. So we'll say AC of sub, and that explains some of the movement because we brought in 4220. So now that's note 4, so we see do we have anything else, and we've one other element here, and we'll deal with that in a second. You'll see why that's important. It doesn't really go into the double entry here, but that's to do with your amount outstanding. So whatever you bought property, plant and equipment during the year, you didn't pay for 120 of it. So that will impact on the cash flow because it's outstanding at year end. So if we look at here, we've 30,000 this side in terms of our closing balance and all our credit adjustments, but we've only 27 this side. So there must be a balancing statement here, or balancing figure, or plug of bank, which essentially, or not bank, should I say, acquisition of PPE. And you'll see why it won't be bank for in a second. So the acquisition must be the balancing figure of this minus this minus this of 3170. So essentially, as I said, it's like a puzzle from before. We're trying to explain how the movement went from 23,240 to 26. We know a couple of things already in terms of revaluation, depreciation and disposal and the sub, and the balancing figure then of the plug must be what we acquired during the period. Now the point I didn't say this was bank because it wasn't all paid in cash. So this is one little trick that I'd say put in a reminder in any cheat sheet you do, is you didn't actually pay. So acquired PPE for 3170, but outstanding at year end you have 120. So you didn't actually pay the full amount, you only paid 3170 minus 120. So cash paid, and that's an important one to capture that, because remember we stripped it out before. So it's not just enough to do to here, you need to make sure you capture this 120 as well, because you haven't paid that at year end, it's still outstanding, therefore it's not a cash flow figure. So working 5 then, hold that off, AC of PPE working 5 minus 3050. So again, we're working down through them and we're filling in as we go along and we're building marks. So that was one of the more difficult ones in terms of how to deal with property, plant and equipment. There's typically a good few. So it might be an idea to set up, as in your notes, a standard template property, plant and equipment double entry account or journal entry account, such as here, and put in all the possible ones so you can have a checklist to remember, well, is there anything to do with revaluation here, so you won't forget. Right? So we'll move on now to the next one. We're working down systematically. We've done property, plant and equipment, so let's now look at intangibles. So again, same thing, we'll start working 6. How can we explain the movement from 950 to 1200? And there's one note associated with here. We have amortization. So we'll go here working 6. So I'll just get a copy of a template to bring down. So we bring this up. So sometimes you'll want to use them for the start, in particular in terms of intangible or for T accounts, and after a while you may argue, actually I don't need T count for everything, it's only certain more complicated ones. So the closing balance, or the opening balance should I say, on intangible assets is 950, and the closing balance is 1200. And we want to figure out how do we explain that movement. So essentially there's really two main elements that will explain it. One is any amortization, which we know in our SPLOCky, so it'll be debit SPLOCky expense, credit intangible assets 95. And the only other one then we want to figure out is, well, is there any goodwill on the acquisition of the sub? So if there's a disposal, you might be getting rid of de-recognizing goodwill, but in this case we have an acquisition. And however, we already know from our working over here, there was no goodwill, therefore it would have no impact on intangible assets. So you can say sub / goodwill, if you want to put in, is nil. So the balancing figure must be bank or acquisition. You acquired other intangible assets, be it brand name or something like that. And the balancing figure is 1295 minus 950. So you must have acquired, to make the balance work or to make the movement work, 345,000 of intangible assets. You're not told of any outstanding balances at year end, therefore it must be all cash. So AC of intangible assets working 6 minus 345. Okay. So again, it's a systematic. So I like this question as it comes up as a group because it's very methodical and there's a lot less moving parts than there is in a more traditional type question. For example, if you've got an FX question. So we're now moving on. We've explained these two movements. We've explained inventory and trade and other receivables in our working 1. We know this is the answer. That is the end. So we don't need to do anything with that. And now we're down to ordinary share capital and share premium. I always tell students deal with this together because essentially any transaction will impact both accounts together. So just add them together and you can do one merged account. So it's 2,900 here and now we're at 4,200. And we have to try and figure out, well, what explains that movement. So back to another T account. We do now working 7. And I call this OSC times their premium. So just bring them together. Just delete some of these and delete these. So the opening balance here, we'll add the two together, 2,500 plus 400. If you do them separately, it won't really make sense how you're going because remember, any issue of ordinary shares will impact both accounts together. And the closing balance, which is the balance obviously carried down. So the closing balance is on the debit side because when you bring it down, it'll be an opening balance on the credit. It is 3,400 plus 800. So there's been a movement here of 1,300, and how can we explain that? Are we given any notes in the account of how to explain it? And one typical one, watch when it's an acquisition of a sub, you did allot shares, and you allotted shares worth 1,020. So put that in. It would have been debit, the assets, credit, ordinary share capital and share premium. So we'll put in here AC of sub. Right? And that AC with sub would have been in terms of 1,020. Right? So that's one important thing. So now we've explained some of the movement, but there's still some mismatch here. So we're not really told of any other element in terms of ordinary share capital. So again, the plug figure must be to do with bank. You must have issued more shares. So we look at bank here. The balancing figure is, take away these, 280. So you must have issued shares during the year, debit bank, so cash in, credit, ordinary share capital and share premium. So you don't know the split between ordinary share capital and share premium. That's why we look at it as one account. Now note, be careful on how you show this. This is not investing activities. This is a new one. So just leave a few lines. This is financing activities. And there should be no excuse for students in terms of labeling it wrong. You will have a model set of financial statements that I'll have showed you in the session. Get the template one from IAS Plus, and you'll know exactly where each line item goes. So this is share issue. So remember, the issue in terms of acquiring the sub, that is non-cash. All you're doing is swapping shares. There's no cash issue there, but there is for 280, working 7, you got 280 from a share issue. Right, so that's another additional complexity that you'll see as part of group statement of cash flows. So we're working down through. We've now explained another two, so you can see how it's like a little puzzle. You're working your way through. We've done that. Revaluation surplus, we've explained that in accordance with our working in terms of property, plant and equipment. So there's no extra work there. We've explained that 400 movement. Now retained earnings. This is one that students always forget to do. That's why I tell you, work down line by line. There's a movement in retained earnings during the period. It's gone up about 3.3 million. And you're told in note 6, you don't need to be told this. There were no movements in retained earnings other than profit and dividend. So ultimately, if you're not told this either, you know the plug figure must be dividends paid during the period. So you open up your, similar again, working 8, retained earnings balance, retained earnings account, the opening balance, we'll delete these. Remember, this is important because you need to understand your individual cash flows because this is essentially a normal IAS 7 question. So opening retained earnings was 16,370, closing was 19,625. So a movement of about 3 million. And how do we explain that? Well, you know from your CAP1 days or any financial reporting days, retained earnings movement is really just profits for the year and dividends. So look what profits for the year were. And it's important, ask yourself now the question, which one should I take? Is it the 4.8 or the 3.8? And then you should know from any preparation of statement of changes in equity, it's the 3.8 that goes into the retained earnings. This NCI part goes towards the NCI. So you can look at, it would be Splocky, and it'll credit balance, it'll increase your retained earnings by 3876. So we'll notice now actually, well, there's still a difference here now on this side of about 1 million, or a bit less than 600,000. So what is that balance? Well, it must be dividends. So if you pay dividends to parent during the year, it will be credit bank, i.e. cash outflow, therefore it should be in the statement of cash flows. And it will also be debit retained earnings. So you're reducing your retained earnings, and it will show up on your statement of changes in equity. And the difference is 621. So you have 621 of dividends paid during the period. And note, you wouldn't, and if the examiner was feeling a bit nastier, you wouldn't have to be told that line, and you should know the balancing or the plug figure in the retained earnings T account should be dividends. So working 8. Now you'll see in the suggested solution you can put dividends up here in operating cash flows if you want as dividend paid, or equally you can put it down in financing as long as you're consistent year on year. So I'll just put it in financing, div paid to parent. It's important to put in parent because there could be a dividend paid to NCI as well. Working 8 of minus 621. Right, and that's that one done. Again, that's a standard statement of cash flow question, so you should be comfortable how to deal with dividends to the owners of the parent, not the NCI, the owners of the parent. So now we've a good chunk of work done, and we're now on to one that's unique to group statement of cash flows, is non-controlling interest. So we started with an NCI of 4.9, we ended up with 5.4. How do we explain that? And again, there can be really only to some extent 3 real issues, and that's why I said do up a cheat sheet. You can either give profits for the year for the NCI, so such as down here, they made some profits. Secondly, you can have an acquisition during the period or a disposal. So for example, did the acquisition or disposal in the question impact on how we recognized NCI during the period? And of course the final thing is any dividends paid to NCI will reduce their interest as well. So we can make those notes. Is it profit for the year? Can explain the movement, an acquisition or disposal, or finally dividends paid. And again, easiest way to do it, in my perspective, is open up a T account. So working 9 NCI. The opening balance we know is 4930. We don't know what the profits are yet. We'll look at that. The closing balance was 5440. So there's an increase of about €500. 500,000 should I say, and how do we explain that? Well, one, we know those profits attributable to the NCI, so put in that 969. So you know the NCI would get that share of profits in their account. Similar, it'll show up in the statement of changes in equity. So again, there's a lot of assumed knowledge in terms of your basic knowledge of Splocky, SOFP, and statement of changes in equity in terms of group accounting. So you need to know them first before you tackle this. Next thing we know of the 3, the acquisition and disposal. Did that impact on the NCI? Because we know we purchased all of the ordinary share capital, we know there's no NCI, therefore we can say here, AC, you don't even have to put it in, is nil. So there's nothing there in terms of NCI. Okay? So the only other possibility is dividends. So similar to retained earnings, except now instead of looking at the parent, you look at the NCI. You must have paid dividends to the NCI during the period to reconcile the closing and opening balances. So we look at here, it's 5440, 5899 minus 5440 means you paid 459 to the NCI dividend. So you debit NCI, credit bank is how that works. And if you credit bank, you must show it in your statement of cash flows. Again, a financing activity. Div to NCI. This here's right. Working 9 minus what's it? 459. So another outflow from financing activities. So now we're working well down through them. Again, another one for specific to group is NCI. Next one now is long-term borrowings. So students might want to do this together. It's probably the best to do borrowings together, similar to ordinary share capital and share premium. Do long-term borrowings and current portion of long-term borrowings together because they're going to move with the same transactions. Alright, so we go down now and we get working 10 in terms of the debt. So the long-term and short-term balances, we just call it working 10. We call it long-term / short-term borrowings. So you just add them together, just easier because you're going to do the same transactions they're going to be impacted by anyway. As the opening balance plus 280. Delete these. That's the opening balance is 2800 at the end of 2013 plus the 280, and the closing balances are plus 2350 plus 235. So you see the debt has fallen by about 500,000, and we want to explain, well, can we explain any of that movement? Has anything happened that that can explain that? So we just look down through the notes and see is there any information about the long-term or short-term borrowings. And we see here one of the most important things is to always double check, look, have you anything left in the sub? And we do. We took on additional debt of 120. So this will be acquisition of the sub. You would have additional debt, that's different than you would have in a normal IAS7 individual question of 120. So we've now captured everything to do with the subsidiary acquisition. So there's still a bit of a difference here now. So the difference must be bank, i.e. repayment of loan. So if the loan has fallen down, there's no other information, you must have repaid some of the loan during the period, and you take the 3200 minus 2585, looking at that you have repaid 615 of the borrowings over the last period. Alright? So if we go back up then, working 10. So this is financing activities, repayment of loan, working 10. So you see it's nice and neat here. It's very clear. You've left the page, or probably leave 2 pages. You cross-reference all the notes to go along, and this is minus 615. So we just look up now at the statement of financial position. Is there anything else to explain? We've explained trade and other payables in our working 1 and the relevant for tax and for property, plant and equipment. We've explained tax and we've explained long-term borrowings. We've now everything explained. We double check. The next step is to now tot up. Well, what is our cash flow from investing activities? It's the sum of all these. To bold that, just copy that down. And what's the cash flow from financing activities? Well, we just sum up all this and we bring it down as well. So overall then, if we bring all these together, hopefully the net cash flow for the period, so just bring down these 1 or 2, is from financing activities, from investing activities, plus from operating. And it equals 240, so happy days. We know that that's the right answer because we know that 140, which is the opening balance, closing balance, so this is 140, and this plus this equals 380, which we know is the 380 up here. Now, if in the case, and it may be likely in the case in the exam, it may not come back to the answer you know it should, there's a few steps you need to go through. 1, check every single line item in the SOFP, make sure you have accounted for each of them and you've explained all the movement. And secondly, double check your notes, particularly the acquisition or the disposal, and make sure you've captured every single line item, the impact here, just to double check you haven't left out one of them, which will distort your answer. Right? But again, the point is about the consolidated statement of cash flows is it's probably, in my opinion, the easiest of all the consolidation questions to come up because it's very structured in the approaches you take. There's only 2 or 3 difficult issues in terms of is it an acquisition or disposal from a subsidiary during the year. We didn't deal with an associate here, so go back and look at that chapter 11 in the Mahoney book to deal how you deal with an associate. Very similar. We'll open up a T account. So these steps, just open this here. So these steps are very useful in terms of giving you, again, as I said, they're high-level steps. As you refine no more than your question 1 approach, you will decide what best suits you. But the most important thing to take away from this question is you need an approach. Use T accounts where possible just to understand where the debits and credits are going. And in particular for some of the main difficult areas, do up some notes so you have them as a memory aid in the exam should this question come up again. Okay, so that was Summer 15, question 2, consolidated statement of cash flows.